My name is Mike Florin, and I'm the owner of Low Cost Mortgage. Today's your weekly update for, June, July, August 14th, 2024. I'm going to edit this a few times because there's kind of a lot to talk about, and I want to make sure the information is being relayed to you guys completely. So you're going to see these little edit marks. It's not normal I do that, but there's kind of a lot going on here, okay? So first and foremost, the 10-year Treasury and MBSs are not quite correlated right now. They usually are. If the 10-year Treasury comes down, rates come down, but we've had this hesitation where the 10-year Treasury comes down, but mortgage rates are kind of sitting and settling where they were last week, which means a few things could happen. Mortgage lenders, for the most part, are going to be extremely conservative, right? And with that, it's going to be, they're really quick to price worse, but they're very slow to price better. And we're seeing competition start between the different investors, not the little investors, but the different investors, where one starts to move down a little bit, then the next one follows, the next one follows, the next one follows. Now, most of these investors have opened up the 4% range inside of their pricing sheet. Let me put a little image here of a pricing sheet. And a few weeks ago, I put one up where the limit was 5.1. That was just the lowest you could go. And yet another investor had it in the 4s, 4.6 or 4 or 5 or somewhere in that general range. With that being said, that's when an investor is showing that rate is available, that investment coupon is available. Now, if they price it out accordingly where the lenders can make enough money on it, or the price for discount is low enough, then it makes sense to move down there. So when it comes to pricing and interest rates, this is what a lot of realtors don't understand, because you're just not subjected to it quite a bit or a lot at all. And on the lending side, regular loan officers kind of see it sometimes, usually not on the ownership side, or secondary markets, the lock desk on different investors. They play with it all the time. And that is the following concept. Interest rates itself has specific payoffs. And an interest rate has not payoffs, but payouts, okay? So a specific interest rate is worth a certain amount of money. So for example, let me look at my sheet real quick here. I've got a pricing search that I did earlier. And for this particular search, 5.5% interest rate paid out 1.75% of the loan amount, which means 5.5%, if it's a $500K loan, $6,000 and some change is the payout for that particular rate. With this same investor, if the borrower were to get 6.25% interest rate, and I'm going to put this little image up there so you can follow, but if the borrower got 6.25% on the rate, then the payout would be 2.86%. So that means that if it's a $500K loan, I mean, you're looking at what, $15,000 or so. And that's the payout to the lender or the broker or the loan company itself. So even if you're a direct lender, there's still going to be money that's paid for each rate. And I'm overly simplifying this just to make sure the concepts are pretty well understood, okay? But with that being said, what dictates rate in reality, the easiest way to think about it is this way. Each interest rate has a certain payout amount, and that payout amount dictates how much the broker, direct lender, correspondent lender, whoever that lender is, the retail side. So for the borrowers that are dealing directly with us, we are acting as retail. And then the borrowers dealing with, even if they're dealing with like Wells Fargo, if they go to Wells Fargo to get a loan, they're dealing with Wells Fargo retail. But if we deal with Wells Fargo, then we're dealing with Wells Fargo wholesale, right? So the difference this last week between retail and wholesale was pretty simple. I had somebody come up to me, and it's one of our investors that we use regularly. And they said, hey, I contacted this investor. They just contacted them through the retail channels, and they were quoting me, I think it was like 6.3 is what my rate would be. And then that exact same scenario, if we were to bring it to that investor, we'd be at 5.5 for the same costs. Now, that means that they're low sixes if they go retail, but then us on the wholesale side, because our costs are so low, our systems are so streamlined and we don't have a lot of fluff in the rate, so our margins are just really small. It allows us to take that same loan, put it with that same investor at a much lower rate. Why? Because it costs that investor more money or that lender more money to sell directly to the public than it does for us to do the loan for them. So anyways, that's an example of retail to wholesale and the kind of difference that you could have. I could take a loan and park it at, not Wells Fargo because we don't get many loans at all, but let's just say an example would be, well, I don't want to give an example, but bank number one, if we go to bank number one, we could deliver that loan to the borrower at 5.5%. With no origination, no discount. So then you're looking at, I don't know if I have to quote APRs on something like that, but anyways, we can give it to them in the mid fives. And then if they go directly to that bank and say, hey, give me a loan, they're going to be in the low sixes because we're just cheaper that way. With that being said, that differentiation doesn't really make doesn't make a difference at all, other than each interest rate has a specific payout, and that payout dictates how much money the direct lender, correspondent lender, broker is going to get. That also correlates directly to what rate the borrower is going to get, because each company has a different set of margins they have to make to break even. Ours is really low. I have a company that's extremely cost efficient. In fact, if I turn the camera around and you saw the rest of the office, you'd see that I'm kind of in a remodel, setting up another filming area and doing a few other things where the office space isn't really that nice, but it doesn't need to be. Why? Because I never meet with anybody. We operate in a bunch of different states, and who's going to fly to Colorado to meet with me to talk about a loan when we can do it over the phone? Doesn't make any sense. But you have a lot of companies that have a lot of expensive office spaces. They have a lot of management. They have a lot of costs associated with doing business or just staying open in general. And those companies need to have higher margins. They need higher margins because they have higher costs. So we're low-cost mortgage because our costs are low. Cost to the borrower, but also cost to us. We just minimize the cost on absolutely everything. So this is how we beat people. I'm going to pop open that same chart again. With this particular investor, this particular scenario, 5.5 would be the rate. Here's the APR on the picture because you got to do that to stay compliant. I don't know what it is off the top of my head. But we would be right around 5.5 on this scenario, and most of our competition would be in the sixes. I'll just circle it, so you can see where most of our competition is. That margin spread is roughly the difference between a low-cost model and a average model, your average lender, if that makes sense. Now, the 10-year Treasury and MBS is not being correlated. So this is where it's going to come back around to that, right? So you have payouts for different rates, and I'm sorry we went down that rabbit hole, but you have a payout for a rate. And coupons. Investment coupons are in 0.5% increments. So the investor is going to get a 5% return, 5.5% return, 4.5% return, but nothing in between. So when there's a payout for a rate, so right now we'll just use the same example, even though these aren't real rates today, but this is just a specific scenario. On this specific scenario, 5.5 is paying 1.3%. Yeah, 1.3%. And if you notice, you can see rates that are up in the fours, yet the fours cost money. They're red numbers. They're negative numbers. What you'll see is right now the investors really want to make 5% return, and they're marking it up to 5.25, 5.3, 5.5, paying out certain amounts so that way the investor can still get 5. So they've opened up that next coupon, which means they're getting ready to accept loans in the fours. But there's a few caveats there. The lender or the investor in this particular scenario might want to or might set up their plumbing for the fours, but they still need money. They still need investors that say, we're okay with getting a 4.5% rate of return. Well, you're not seeing that yet. In fact, not very many mortgage companies are offering rates in the fours. In fact, almost none of them are today for different scenarios, right? At par. With cost being zero to the borrower, no origination or discount points. Of course, you can buy down to get there now. Why? Because the plumbing's there, and there's some investors that'll do it, and of course, you got to pay money to get there. But let's look at the 10-year Treasury, and I'm going to put a historical 5-year history here on here. I'm going to draw a line. Okay, 5-year history. I'm going to draw a line, and if you notice, the 10-year Treasury is right about where it was last December. And it's roughly where it was last, I think it was December, I got it right here. December of this year, July of last year, March of last year, and roughly October of 2 years ago. That's roughly where it is sitting. So has it come down a lot? Well, not in the big picture, but in the small picture it has. Let me pop open another picture here, or a graph of the last 3 months or so. And you can see that the 10-year Treasury came down, went back up again, and then started going down again. And today it's been relatively flat. I don't know if that's going to flatten out or go back up. That's why you're not seeing investors price back down into the fours yet, because they want to see what happens with the 10-year Treasury. And that money from the Treasury, those investors are going to move money to the MBS markets, and then they might want to put their money in a place where they get a better rate of return than the Treasury is offering. Just that's kind of roughly how that works. So that's that 10-year Treasury mark, and that's where it's moved recently. Now, I like to do these things without edits, but that's going to be impossible today because I'm talking a lot about a few things, and I'm just going to reorganize that. Let's see here. Another good concept is going to be, let's see, we got the 10-year Treasury done. We got that. MBS is not quite matching up. Oh, let me do a comparison real quick. So this comparison is going to be 10-year Treasury on my right, MBS is on my left. I'm going to take the MBS chart, I'm going to flip it upside down, okay? Now, this is where I want to show you that the 5.5 or the 5.0 MBS, it really doesn't matter because the payouts are generalistically following the same trend. You're going to see the 10-year Treasury coming down, but then you're seeing this chart move and then kind of stop a little bit. It doesn't move as much as the 10-year Treasury. And that's part of that being conservative. The MBS is not quite following 10-year Treasury. Happens sometimes, very rare, but it does happen. If the 10-year Treasury continues to go down this week and into next week, you're going to see rates most likely open up that 4 coupon and rates are going to dump into the 4s. Now, at par with no origination, no discount, right? Now, with that all being said, what am I doing with locks right now? I'm not locking. I'm not locking anybody. But I'm set up a little bit different than most loan officers are because I own the company and I also produce loans, right? But if you see this screen here, this is where I work. These are what I'm staring at all day. Not the low-cost mortgage spinny bit that's moving around. I mean, not that, but I've got these different screens up, these different displays showing treasuries and money that's being moved around so I can predict when rates are going to get worse, what that's going to look like, or at least try to predict it. And with that being said, I'm here all day, every day, right? I'm open. I take calls from 7 a.m. to 11 at night. I'm typically here in front of this machine from about 8 in the morning or so till about 4:30 to 8 p.m. I'm in front of this machine right here with all these displays, kind of going through what's happening with rates. So, but right now, and by the way, I don't follow Abib or anybody else saying, oh, rate lock now, float now. I just don't. There's no need for that when you have the data in front of you. But let's talk about rates real quick. Rates are kind of settling roughly where they were last week or so. Now, I'm going to lcmloans.com/rates. If you want to go there and search, do it. You can see everything I'm looking at. Also in your email is going to be rates too. But remember, I'm sending an email, so I only do one scenario and I keep it super generic, very vanilla, okay? So I run a 760 FICO score, 425 purchase, and I do 25K down. And what that does is that puts it just over 5%. Now, VA does not have a different pricing hit if you put 5% down or 0. It's the same pricing. And FHA, same thing, same pricing. Conventional, 5% down is kind of that minimum. But at the same time, you can do home ready, which is 3%. Now, my search engine, lcmloans.com/rates, is not showing home ready. And the reason is that's a special program that's for first-time home buyers-ish. And the rates on home ready are 1/8 to 1/4, sometimes 3/8 better than conventional. So I want people to see conventional. I want them to see a regular rate that's higher than what they could get. So if you look at this conventional, it's showing par at about 6.3, the APR 6.7. That pays back $1,000 lender credit. Well, if you're home ready, you're going to get a better deal by 1/2 to 3/8 of a percentage point. Depending on the scenario, depending on credit score, it depends, right? But with that being said, So you're looking at lowish sixes, and with one discount point, you're in the fives. With a little bit more than one, you're in the mid fives. Actually, no. I would say high fives, just to play it safe. But again, on conventional, depending on scenario, you're there. Last week, I locked somebody. They actually did a discount. I didn't want them to, but they did. Less than 1% of discount, and they got 5.6 on the rate for conventional, right? So again, you can search that scenario, and at that one point in time, we just went in, locked it, we're good to go. So on conventional, though, the cheapest investor is not in there. It's not in there, okay? I don't want people to see the cheapest investor. One of my competition will be like, oh my gosh, that's really your rate? Yeah, it is. But I don't want them to spark that competition that badly, but I don't want borrowers to see a rate that they might not be able to get. Okay, so now let's look at VA and FHA. FHA and VA. Okay, so what you see is the conservative investor in here. So right now with this search, again, same criteria as before, 760 FICO, 425 purchase price, 25K down, means 400K loan amount. Military is disabled. Okay, I think that's all the disclosures I need to do. Oh, Colorado, a single family home. Okay, all right. With that being said, it shows in my system VA is 5.5 getting back $500 and 5.5 for FHA getting back $1,000 that lender credits. But in all reality, my cheaper investor is currently at a VA of 5.1 at par, paying no money, getting no money back, but paying no money. And FHA is same thing, 5.1 at par, roughly, give or take. The APRs on that, 5.1 is going to be on VA is close to 5.1 is going to be close to 5.3, and on FHA, 5.1 is going to be close to like 5.8 or so, somewhere in there. Anyways, the URL's down on the bottom here. Go to the website, run your own searches. But just remember, on conventional, okay, if it's home ready, it's 1/4 to 3/8 lower usually, day by day, hour by hour, and regular conventional is a lot of times 1/8 lower. Again, it just depends. And in here, you can do owner-occupied, investment property, whatever else. So the reason I have this search tool up is efficiencies, which, give me a second here. And VA and FHA, same thing. VA and FHA is 3/8, sometimes 0.5% better. Today, it's a little tighter. Today, it's roughly 1/4-ish or so better than what you're going to see here. But again, it depends. Now, the cheaper investors have rules, and those rules don't allow it so everyone can get a loan at that price point range, which is why my rate search engine or search tool, lcmloans.com/rates, only shows investors that can take almost every scenario. They're basically the most liberal for rules, right? Rules for overlays and whatnot. Basically, no overlays and fairly fast service. The super cheap ones, they take a long time to do a loan. They inherently do. They're just inherently slower. All right, well, rates are heading down, and hopefully they keep going down, and time will tell. Right now there's recession fears. The recession fears are kind of heavy, kind of hot. But we'll just see what happens. Inflation, the numbers are showing that the Fed should decrease their rate. That's what all the data is showing. Let's see if they actually do. So anyways, my name is Mike Florin. I will talk to you guys later. Have a great day.